Welcome to the Turnaround Take. I'm Joe Sarachek, and today I'm joined by Tom Goldblatt, managing partner of Ravinia Capital, a boutique middle market investment banking firm specializing in distressed companies. Tom, please tell me why you started Ravinia Capital.
Sure, Joe, and thank you for having me on. It's an honor, and I should say we do a lot with distress. We also do with healthy companies. At least half of it are helping business owners exit for the most. And why I started it is to help those people. Because people that are selling their company and people particularly in distress, they're really in a spot where they're going up against a lot of seasoned professionals, and they can easily be taken advantage of. And so private equity funds are very smart and they're very convincing. And people need help and they need somebody on their side and somebody that can help them navigate through the water. So I started Ravinia. I went through, a lot of transactions early in my career. I experienced some distress and I learned a lot through all that. And so I love doing this. And so I ended up being an investment banker so I can kind of help quarterback and navigate people through the best solutions and transactions. So that's why I started Ravinia, and it's gone from there.
So, Ravinia, it not only helps orchestrate the sales of company, but it also raises capital for companies.
And we help raise. Now, one thing that we don't do is appeal. Hey, do you invest in deals? No, we only align ourselves with the people trying to raise money so that we get paid when they get money. We're incentivized to help them, and so we go out there and help them raise capital. We try to create options, and our way of looking at it too is, although we have a large database of investors we know, is to try to make it so that everything's aligned up and you create options and competition and allow either the capital raiser or the seller or the debtor trying to get new credit to control, so they can control the process and get the most competitive option. So we put a lot of emphasis on how we go about it and objectively so that we can do it in a very efficient, fast manner, but get people the best possible options.
So a phrase I love is you get paid when they get paid.
That's right.
So
That's right.
tell,
We align
tell me,
ourselves with them. And I'd say that just yesterday I was pitching an owner. And I said, look, you probably don't want earnouts, but you want but if you get it, we don't get paid till you get paid. We're with you. We align. So your interest is our interest. And that's how we want to work. So we're not trying to do something that you want. Sometimes, typically in the industry, as you know, Joe, you get paid more for raising equity than debt. And the funny thing is that people would prefer debt a lot to equity, and it's kind of counterintuitive. So a lot of times what we do is let's work on a blended rate so our incentives aren't adverse to our client.
I like that a lot, Tom, and you must be a man who really believes in yourself and in the companies that you take on. What have you seen in the marketplace in the last 12 to 18 months?
Well, it's a very, as it always is, dynamic time. So the market was it's seesaw. So going into 20, when the pandemic, we thought, oh, here comes the distressed market, and this is going to be it. And it ended up being the opposite. And then the markets went crazy, and valuations went up. There was record deals in 21. The Fed started raising rates in 22. Things went on halt, and it's been that way really since. Now we're starting to see cracks, so you read about private credit, which was the hot property. And now you're starting to see redemptions, money flowing out of that, and lots of feasures. We're starting to see the banks that have held on to things and private equities that held on to things. We're starting to see those things get really stretched out, and we're starting to see more transactions. But I'd say really on the middle market, it's more of the same. On the higher bulge market, there's been more transactions as the antitrust is lessened and all this money going into AI. But in the middle market, it's been pretty much a stall game. We're extremely busy this year at Ravinia, but it's a bunch of oddball stuff that are just kind of percolating up. No trend, but we're on the cusp right now. If you ask me, what's it look like? It looks like there's going to be a ton of things happening because it's harder to get a loan now. But again, we've been wrong about it all. And as soon as it starts to go one way, the Fed jumps in.
So if you're a company that is involved with a private credit lender who wants out, they should be calling Tom, no?
Absolutely. There's always best solutions. And so that's the thing we preach is like we look at situations kind of as a doctor and try to give you a range of options. And there's something you should be doing. And it's kind of a probability field. I analogize it a lot to kind of applying to colleges too. It's kind of like, okay, here's the ones that are probably the best fit. Here's my safeties and here's my reaches. And so we try to simultaneously, because time is always an issue, bring what's going to be a possibility. And, people often kind of get like confused that like, oh, the balance sheet is all tapped out. There's no room here because there's no more collateral to lend on. There's no cash flow there. There's always a solution. As you know, Joe, they could be doing a restructuring. They could be doing, there's different options always that are available. And there's what you don't want to do is do nothing.
Got you. Tom, tell me about an engagement you're particularly proud of and where you created value, because I see you as a value creator.
Well, I love when I'm really making an impact, and I love when I'm making an impact against everybody. And I have several examples, but like the one that comes to mind is Allied Healthcare 2 years ago, and it was like in the newspapers that they're closing. It had, several hundred employees in St. Louis. And I got brought in to possibly sell a division of theirs. And I looked at it and I'm like, there's just too much here that like people need these medical products. And so I immediately said, I got to figure a way to save this company because there's value here. And I've written articles that say, whatever you do, don't liquidate, because there's always more value in my mind as a going concern for several reasons. So I went in and it was really, everybody was against it because they had already given the Warren Act. And so we're really against upstream and nobody kind of wanted to like do what's difficult. But like I was able to convince people to give me 30 days. What I did is I let the board know you have a fiduciary duty to all of the stakeholders to try to get the best solution. And they said, all right, we'll give you a shot. And so we were able to kind of put together materials and within less than 21 days, get out to market, get some offers, show there was real, and then everything started to change. And then we were able to, end up selling it. We had to work with the union to get them to like allow us to rehire people. And the company now is functioning. So it was in the newspapers. It was closing before we got there, and then it was in the newspaper that it's going. So I felt really good about that because we saved several hundred people's jobs and a lot, kept these medical products going.
That's awesome. So you staved off a liquidation by finding a buyer. Really cool.
We've done that several times because it's like what happens a lot is it's just easiest to liquidate because the lenders got their collateral all covered and they know that. And then to allow a sale, it takes a little risk. So you got to kind of align the interest again. So what we'll do a lot of times with a lender, even who's fully collateralized, is we'll say, hey, look, give us this chance for a runway and here's why it'll work, and like we'll convert you to a bridge lender during this, make sure you're protected, or a dip loan during a bankruptcy, and allow us to go out because a company is worth more. Like if you liquidate, as the inventory is hardly worth anything, the work in process, hard to collect the receivables, the IP, everything goes away. It's bad reputationally. But if you can find somebody, there's always some different aspects of a company that have value to other people. So that's what we're all about. And we try at Ravinia to be a positive return on investment. So we go, okay, well, fine, you could liquidate for this. We'll charge, a minimum for our work. But if we could do this, incentivize us. So we kind of align ourselves with the interest and we try to capture and create that value.
What kind of information do you need from turnaround professionals?
That's a great question. The primary thing is we really need accurate books and records, obviously. And so it's like people, if the information is questionable, it doesn't work. The other thing we need from them, and this is a little bit more subtle, we need them to have an imagination. We need them to basically not be able to just see as what it is today, but they need to think with us as what is the value, not like right now, but what if somebody came in that like could bring in $10 million or $100 million? What if like somebody could like, okay, it's true, the sales force sucks and all that, and we don't have full capacity right now. But what if like somebody came in and could bring in that sale? So the ability to see not just what it is now, but what it could be. We love turnaround people. They're straightforward people. They take on anything. We will reduce our retainer to make sure they hire our turnaround people because it works better and we don't compete with them. They compete with us sometimes, which they shouldn't because it should be an independent sale. But we want them in the thing because we want, verifiable, and it's got to be a positive return on investment too. So it's not every situation. Sometimes a company will have very good CFO and accounting people. It's not necessary, but in general, we find it's really good because they're great at knowing how to. So we let them do their stuff and then we focus on the sale.
I loved what you just said about imagination. And this goes to value creation. And really good professionals like you add value. And I respect it a lot. I can sense your enthusiasm for that. And just before we conclude, I got to ask you about your Fighting Illini. And I can't believe they beat Houston.
Oh,
What,
absolutely.
what's
Yeah.
your prediction?
Well, and I don't know when people are going to see this. This is Thursday. We just won last night. We're going into the Elite Eight this weekend. I'm actually really confident. I think we underperformed. The team is gelling now. Brad Underwood is just the last couple of years created new teams. He's found this pipeline. And there was an article in the Wall Street Journal just the other day from Eastern Europe and making us better. And we've got the height. We've got we're gelling as a team. Our defense is good. I think we can beat anybody. And so I'm really confident, and Underwood's just done a great job of bringing these kids together. So it's exciting. It's always the tournament is such a great thing, and
It
and
is.
and when your team is in it and doing well, nothing can be better.
Thank you, Tom. As you know, our investment firm, Strategic Liquidity, buys intangibles. Do you ever see intangibles in
I
your?
absolutely do. And I love that, Joe. And it's like people just disregard. And again, it's kind of like taking the easy way out. And that's what you do too, Joe, is like you're very creative of finding things that like people disregard this and they just want to just be done with things. And like you see, hey, wait a second, are there any like, lawsuits that like they have? Are there things? And yes, we do see those type of things. And you're the first call because you're a guy also that like if you see it, you're entrepreneurial, you're creative, you have an imagination about it, and so you want to look at anything a company has because when you're kind of going down any lever you have to get cash, create value, it's negligent not to be exploring those things. So what you do, and you've almost created a field for yourself where it didn't even exist. And I'm honored to be on your thing and what you're doing with the book you wrote, the classes you're teaching, this podcast. You're kind of like taking your stuff and you're educating this whole community. And it's an honor for me to be part of this and contribute to the what you're doing here.
Thank you, Tom. It's my honor. Thanks for taking the time today and giving us your insight. Please let my audience know where to connect with you.
They can connect to me on the Ravinia Capital LLC website at Goldblatt at RaviniaCapitalLLC.com. And if you have a company that's experiencing liquidity or you're a business owner looking to exit for the most, I'm glad to have a conversation with you. Even if it's not a fit for us, we'll do our best to figure out what's your best options. We're kind of the Dow of investment banking. I used to say, oh, if it's not for us, where should it go? And then we try to refer that out to other people. So we create it. But if you've got a transaction, it's a middle market. We're basically at the 50 million to 500 million level, below where a lot of people you work with. But that's where we love, and we would love to help you with that.
Thank you, Tom. As for me, Joe, please DM me or leave me your comments on LinkedIn. Let me know your thoughts on this interview or any other subject involving distressed assets. Tom, good luck with your Fighting Illini, and we'll speak soon.